Every gold rush has a choke point, and whoever controls it wins, no matter who strikes gold. In today's AI gold rush, that choke point is electricity, equipment, and infrastructure. So I found 6 under the radar stocks sitting directly on that choke point. 2 of them, EROC and EQPT. I'm betting big on with my own money. These are stocks almost nobody covers on YouTube. Within 6 to 12 months, you will see that these stocks have doubled, so pay attention. First up, we got a stock sitting in the same bottleneck as Bloom Energy and GE Vernova. That bottleneck is on-site power generation, and the stock is called EROC. EROC builds modular on-site natural gas power systems. Think of them as giant plug-and-play power blocks you place right next to a data center. They serve data centers, utilities, and large industrial customers across 9 US states with over 2,000 deployed units, about 400 operational sites, and roughly 1,059 megawatts of installed capacity. AI needs electricity, the grid can't deliver it fast enough, and EROC sells the shortcut. The bottleneck they solve is speed to power. Big turbine suppliers like GE Vernova, Siemens Energy, and Mitsubishi Power have backlogs of up to 8 years. EROC says it can get its on-site systems running in just 12 to 18 months. That time difference is worth billions to AI companies racing to deploy computing power. EROC isn't selling generators, they're selling time. Contracted backlog exploded nearly 8-fold year over year to $1.28 billion. That's 778.6% growth. All of that backlog growth came from data center customers. Proof the AI demand is real, not just a story. The company expects to convert this backlog over roughly 3 years, so revenue should ramp up hard. On top of that, the backlog is supported by customer deposits, which reduces capital risk during the ramp up. Revenue is a mix of upfront project sales plus recurring income from operations, maintenance, and asset management services. So once a system is installed, it keeps paying. EROC is strongest in Texas and California, exactly where grids face rapid load growth, congestion, long interconnection queues, and extreme weather risks. The average rating from 8 analysts is buy with a 12-month price target of $22.63, more than 100% above the recent price. This is one of the few pure plays on AI's electricity bottleneck. Not chips, not software, but the power that makes it all possible. If you want to know my projections on how much upside these stocks have, join the Discord, where you will find a link to my Mr. Invest sheet. You will see all the stocks that I track and own in my public portfolio. And the Discord is getting better every single day. You can now track what I buy and sell at any time. You will be updated every day with the 10 biggest headlines. You will be able to see the earnings results plus the 5 biggest headlines from the report. You can see exactly what I own every single week. We got the earnings calendar that shows you which stocks of mine report earnings every week. I track insiders buying and share buyback announcements. You will be also updated every time Congress buys stocks. So enough to keep you updated on the most important things in the market. The next stock is now heading into the golden ages. A ton of companies are now coming to the United States to begin domestic production to avoid tariffs. And building all these data centers requires a ton of construction equipment. This stock is sitting in the perfect spot to capture all that demand, and the stock is called EQPT. EQPT is one of the largest construction equipment rental companies in America. But with a twist, it's built around its own technology platform called T3, a fleet management system with telematics devices, and an equipment rental marketplace. Think of it as equipment rental meets software. The T3 platform is driving market share gains with large industrial customers, especially in data centers, manufacturing, and infrastructure. The company wins business by offering better job site visibility, access control, and equipment management, not by cutting prices. That's a real moat. Competitors rent out machines. EQPT sells a complete operating system for the job site. T3 turns actual job site data into improved uptime, smarter service prioritization, and greater customer control. It's what makes AI meaningful for construction. Demand is coming from industrial, infrastructure, data center, and advanced manufacturing projects. Exactly the sectors getting hundreds of billions in investment from the AI boom and reshoring of American manufacturing. The board authorized a $500 million share buyback program. Management is literally putting money where their mouth is. The stock trades around $18 to $19 after pulling back from its all-time high of $35.50. A company growing nearly 40% per year. Profitable, buying back its own shares. Next up, we've got a stock position to capture a ton of the defense spending of European countries. This is a 10-year trend that forces countries in Europe to spend 5% of their total GDP on defense. And the stock Scandinavian Astor Group will grow very fast because of this. This stock got insiders buying the stock because it trades at a PE of basically 16 and is going for a price to sales ratio of 0.2, while they are forecasting an EPS increase of 30%, and they are forecasting forecasting that their revenues will increase by a shocking 70%. A stock that is growing this fast and sits in one of the best sectors right now shouldn't be trading that cheap. Astor Group is a small Swedish defense company founded in 2021 and headquartered in Kista near Stockholm, and it sits right in the middle of the biggest defense spending wave Europe has seen since the Cold War. The company makes radar jamming systems and composite components for military defense and civil security. Think electronic warfare, stealth technology, ammunition components, and protective systems. These are exactly the things European armies are buying right now. Sweden just joined NATO, and every NATO country is under pressure to massively increase defense budgets. Astor is a direct, pure-play way to ride that wave, and it's still small enough that most investors have never heard of it. The order book stands at roughly $83.7 million. That's nearly double the company's full year 2025 revenue of $45.3 million, already signed and waiting to be delivered. Management has given a clear target, $261.5 million in revenue by 2028, driven by organic growth plus selective acquisitions. From $45 million in 2025, that's roughly a 6 times expansion in 3 years. If they even get close to that target while keeping their margins, today's valuation of roughly 157 to 209 million market cap could look very cheap in hindsight. The growth story hasn't slowed down, but the price has. That's the setup we all love. A small, profitable, fast-growing Swedish defense company with 70% plus growth, fat margins, a record order book, an aggressive but disciplined acquisition strategy, and a tailwind, European rearmament. Next up, we got a stock backed by Kevin O'Leary and is sitting on real estate worth billions. The stock is called Bitzero. Half or more of the announced data centers will never get built because there's simply no power on the grid, and that's exactly where Bitzero comes in. While Wall Street was still sleeping on this theme, Bitzero spent years securing low-cost electricity, land, permits, and grid access across Norway, Finland, and North Dakota. Bitzero provides energy infrastructure and power for data centers. It also mines Bitcoin and hosts third-party mining companies with 4 data centers across North America and Scandinavia. The Bitcoin mining still generates strong cash flow at some of the lowest power costs in the industry. Now, so it's not a cash-burning startup hoping for a miracle, but the real story is the pivot. O'Leary says he doesn't even consider it a Bitcoin miner anymore. He calls it a real estate power company. The game changer, the $2.6 billion deal. In May 2026, Bitzero signed a binding letter with OneCode for a 15-year lease of 110 megawatts at its Norway site to support high-performance AI workloads. Let that number sink in. Roughly $2.6 billion in total revenue for a company with a market cap of only around $350 to $400 million today. Add it all up and Bitzero has over 1 gigawatt of planned AI and HPC data center capacity, a gigawatt, from a small cap most investors have never heard of. The location is a moat in itself. Cheap, renewable, scalable power capacity in a tier 1 jurisdiction, something that has become close to impossible to replicate. These sites were permitted before the backlash against data centers started and are welcomed by the local communities, while elsewhere billions in AI projects are being blocked. Next up, we got the Japanese stock delivering power to the world in a time that everyone needs it, and the stock is called TOYO. TOYO is a solar manufacturing company, but not just any solar company. They control the entire supply chain, from the raw silicon and wafers to the solar cells, all the way to the finished solar panels. That means better margins and fewer middlemen. The majority of their revenue comes from the USA, the single most protected and subsidized solar market in the world right now. This company is tiny. The market cap is only around $226 million. Remember that number. Yes, this small company is already profitable, and they're not slowing down. Management is guiding for $90 to $100 million in adjusted net income for the full year 2026. Now do the math with me. A company worth roughly $220 million expected to earn up to $100 million this year. That's a price to earnings ratio of around 2 to 3. The average stock on the market trades at over 20 times earnings. TOYO is building a 1.5 gigawatt solar cell factory in the Houston area, co-located with their existing solar panel site. Why does this matter? Made in USA Solar gets massive government support. Analysts specifically point to the 45x tax credit as upside for TOYO's US manufacturing expansion. American factories literally get paid tax credits for every cell they produce, and the demand is already locked in. TOYO signed 2 master supply agreements with 2 major US solar developers worth a combined $185.6 million in purchase orders. Real customers, real contracts, real money. On top of that, they have low-cost production abroad. Their Ethiopia facility runs at full 2 gigawatt capacity with plans to double to 4 gigawatts, giving them a compelling cost structure and access to green power. They raised $50 million in June to help fund the Texas factory, so the expansion is financed. The stock ran ran from around $3 to over $17 and then crashed back to around $5, mainly because of dilution from the capital raise. The business didn't collapse, so the question I want you to think about is this. If Toyo actually delivers $90 to $100 million in profit this year, how long can it stay valued at just 2 times earnings? Next up, we have a data center stock that not a lot of people know about, and they are located in Australia. The stock is called Sharon AI. Sharon AI is a neocloud operator, purpose-built to power the next generation of AI and high-performance computing, with infrastructure built from the ground up for AI training, machine learning, and generative AI workloads. In simple terms, they build giant AI factories full of NVIDIA chips and rent that computing power to companies that need it. Over $3.5 billion in deals signed in just a few months. That's more than $3.5 billion in contracted future revenue for a company with a market cap of only around $1.5 to $2 billion. Total AI factory capacity is 132 megawatts, of which 116 megawatts is already contracted to end customer. That's roughly 88% of capacity already sold. Demand is not the problem here. Sharon AI raised $1.6 billion to fund its NVIDIA-based AI factory expansion, and the backers are serious names. Sharon AI's platform is accelerating the build of AI factories and sovereign AI solutions. Countries like Australia and New Zealand want AI computing power on their own soil, not in America or China. Sharon AI is the local champion in that region. Now, if you want to do me a favor for the work I put into this research, smash for me the like button. It really helps out a lot.